So, are you thinking about swapping the gray British skies for a sunnier, low-tax life? Well, you're definitely not alone. But before you go and book that one-way ticket, you need to know there's a minefield of tax rules to navigate. And if you get it wrong, your dream of financial freedom could turn into a multi-million-pound nightmare.
Now, to guide us through this pretty complex world, this entire breakdown was put together by the experts at Pro Tax Accountant. They're one of the UK's top accounting firms, and trust me, they live and breathe this stuff every single day, so we're in very good hands.
I mean, we all dream about it, right? Escaping the high taxes, the endless rain, and just trading it all in for a life of financial freedom under the sun. It sounds like the perfect plan. But what if I told you that for way too many people, that dream turns into a very, very expensive reality? Okay, so here's the hard truth. One tiny mistake, a single little detail that you overlook in your exit plan could literally cost you millions of pounds. You should never, ever underestimate the reach of HMRC. Their arm is very, very long. So, how do you actually make that clean break happen? Well, we've structured this guide to give you a clear roadmap. We're going to start with the dream versus the reality. Then we'll dive into the nitty-gritty of the Statutory Residence Test and the dreaded temporary non-residence trap. We'll also unpack the brand new inheritance tax rules and, most importantly, show you how to plan your escape the right way. And finally, we'll talk about why getting expert advice is, well, completely non-negotiable.
Right, so where do most people go wrong? It all starts with this one big misunderstanding. So many people believe that the second their plane leaves the tarmac, all their UK tax worries are just over. If only it were that simple. The reality is, leaving the UK tax system is a formal process. It's not just about physically leaving. And this isn't some small niche issue. Get this, in 2024 alone, it's reported that over 13,000 millionaires packed their bags and left the UK, searching for that financial freedom. But here's the key thing. For every single one of them, just leaving wasn't enough. They had to prove it to the taxman, and that's where we hit the first major hurdle. And that hurdle is called the Statutory Residence Test. I want you to think of it as the first, and honestly, the most important challenge you're going to face. It's the official, rules-based process for proving to HMRC that you've genuinely cut ties with the UK for tax purposes. It's their checklist, and you have to pass it.
So, the Statutory Residency Test, or the SRT for short, is this complex framework that HMRC uses to figure out if you're a UK tax resident for a specific tax year. Now, this has nothing to do with your passport or your nationality. It really just boils down to two key things: the number of days you physically spend in the UK and the number of connection ties you still have with the country.
The SRT itself is broken down into three parts. First up, you've got the automatic overseas test. If you meet these conditions, you are definitively non-resident. No questions asked. It's the cleanest break you can get. Second is the automatic UK test. These are the black and white rules that will, without a doubt, make you a UK resident. But it's this third part, the sufficient ties test, that's the real minefield. It's the grey area, and it's exactly where most people get caught out. Just look at this table. It shows you just how delicate this balancing act is for someone who's recently left the UK. See the relationship here? The more days you spend in the UK, the fewer ties you need to be considered a resident. So let's say you spend, between 91 and 120 days back in the UK, maybe visiting family and friends. You'd only need 2 ties to get pulled right back into the UK tax net. And what counts as a tie? Well, things like having your spouse or your kids in the UK, having a place to stay available to you, or working in the UK. Let's take Maria, a freelance consultant from London. She moves to Dubai, but she comes back to visit her parents for 95 days. She keeps a room at their house, that's one tie, an accommodation tie, and she still has her old UK bank account open. That can be another tie. Boom, 2 ties. And just like that, despite living and working in Dubai, HMRC considers her a UK tax resident for the year. See how easy it is to get it wrong? And here's a pro tip that catches so many people out. Think you're just on holiday? Well, if you spend more than 3 hours answering work emails or taking a few work calls while you're visiting the UK, HMRC can actually count that as a workday. And if you have more than 30 of those UK workdays in a year, that creates a powerful work tie. It just goes to show how every single little detail matters. And speaking of details, the next trap is where so many successful entrepreneurs get caught. Stay with me, this one is absolutely crucial.
Okay, let's talk about the temporary non-residence trap.
This is a particularly nasty rule. It's designed for anyone who leaves the UK, makes a huge financial gain, like selling a business or some investments, and then comes back to the UK within 5 years. It's basically HMRC's boomerang tax, and it can come flying right back at you when you least expect it. To see how this really works, let's walk through a real-world scenario. Meet John. He's a successful entrepreneur who has spent decades building up his company and is finally ready to sell it and enjoy his hard-earned money abroad. So let's follow John's timeline here. In year 1, he does everything by the book. He carefully plans his exit, he becomes non-resident, and then he sells his business for a cool £10 million. He thinks, fantastic, I'm free from UK capital gains tax. But then, in year 2, he comes back to visit family for the summer, checks on a couple of investments, and ends up spending 95 days in the country. By year 3, HMRC looks at his visits, looks at his ties, and decides he's a UK resident again. The consequence is just devastating. A shocking, retrospective tax bill on the business sale he thought was completely tax-free. And the price tag for that mistake? A staggering £2 million. That's the capital gains tax he owed on his $10 million gain. And the craziest part is, the gain happened while he was technically non-resident. But because he became a UK resident again within 5 full tax years of leaving, those temporary non-residence rules kicked in. They let HMRC look back and tax certain income and gains from that period as if he'd never left. It's a brutal lesson in the importance of long-term planning. But the traps don't stop there. You see, the tax landscape is always changing, and there's a huge shift coming from April 2025 that is going to completely rewrite the rules for inheritance tax for anyone living abroad. This is a big one. This slide really shows a massive shift in how they think about it. The old system, which is in place until April 2025, is based on this fuzzy, centuries-old legal idea called domicile. It's incredibly complex, really subjective, and it often meant that even if you lived abroad for decades, your entire worldwide estate could still be on the hook for UK inheritance tax. The new system? It scraps all that and bases it on residence. The new rule is much simpler. After you've been non-resident for 10 straight tax years, your assets outside the UK will fall completely outside the scope of UK inheritance tax. This creates a clear, predictable timeline and a massive planning opportunity. But it also means there's a new 10-year countdown you absolutely have to be aware of to protect your non-UK wealth for your family. And here's something else to keep on your radar. Did you know the UK government is reportedly thinking about a new 20% settling up charge, which is basically an exit tax on the assets of people who leave the UK? Now, nothing's confirmed, but this would bring the UK more in line with countries like France and Spain. What it really shows is an increasing political focus on taxing wealth as it leaves the country. The rules are always evolving. Okay, we've laid out all the traps, and I know it can feel a bit daunting, but knowledge is power, right? So how do you actually plan that clean break? This section is all about the practical, actionable steps you can take to navigate this path and avoid all those costly mistakes. Here it is, your essential checklist. First, you have to be incredibly disciplined with your UK visits. Aim to limit them to well under 90 days a tax year. That gives you a nice buffer. Second, you have to actively and clearly sever your ties. Sell or rent out your UK property, close down those unnecessary UK bank accounts, and resign from any UK directorships. Also, keep meticulous records of everything, flight tickets, work diaries, you name it. And crucially, you need to understand something called split year treatment. This is a vital rule that lets you split the tax year you leave into 2 parts, a UK part where you're taxed on your worldwide income and an overseas part where you're not. If you get this right, you're only taxed as a UK resident for the bit of the year you are actually here. Get it wrong, and HMRC could tax your global income for the entire year. And finally, always think long-term, especially with that new 10-year inheritance tax clock now ticking. Which, brings us to our final and maybe our most critical point. Get expert tax advice. With all this complexity, the constantly changing rules, and the multi-million-pound stakes, trying to navigate this minefield on your own isn't brave. It's just a massive financial risk. And on that note, we have to be really clear about this. The information in this discussion is for general guidance only. It should absolutely not be relied upon to make personal financial decisions. Every single person's situation is unique, and it needs personalized professional advice. For that expert advice on planning your UK exit, or any other tax matters for that matter, you should really speak to the specialists who helped put all this material together. You can contact Pro Tax Accountant directly on WhatsApp or by phone at 07985 or you can email them at info@protaxaccountant.co.uk.
So we'll leave you with this final thought. You've seen the dream of financial freedom, and you've seen the potential nightmare of a hidden tax trap. So is your plan for that freedom built on solid ground, or is it about to walk straight into a multi-million-pound mistake? The right advice really does make all the difference.